Here we're going to be looking at treasury stock. We're going to be using the cost method here for acquiring and reissuing treasury stock. And what we mean by treasury stock, this is stock that the company purchased back here that they had originally outstanding as common stock. And we're going to be looking at the situations here. We're going to acquire some treasury stock, and then we're going to reissue this treasury stock. And for example here on 2/1 we acquired treasury stock here. We bought 200 shares back here at $40 per share. So that's the cost of the per share here for our treasury stock. So that equates here to $8,000 that we're going to have to pay out for acquiring this treasury stock. And in this case you have no gain or loss here on acquiring treasury stock. Now on 3/1 we reissue treasury stock 100 shares here at $46 per share here, and that equates to $4,600. So here's where we're going to have a gain here because our selling price of $46 is greater than our purchase price here of $40. So we're always going back and we're comparing it to our purchase price here when we're looking at our cost method here. Now in this case, gains are credited to the treasury stock additional paid in capital account, which is a contra-equity account. Now on 4/1 here, we're going to reissue the remaining 100 shares of treasury stock that we hold here at $24 per share. That equates to $2,400. Now in this case, we're going to have a loss here because our selling price of $24 per share here is less than the purchase price here of $40 per share. Again, we go back and we compare it to our cost here, what it cost us to acquire it, and that was $40 per share, or we had to purchase it back here at $40 per share. Now in this case we're going to have a loss and we're going to debit it to additional paid in capital, and reducing the balance, we're going to reduce the balance here to 0 in our additional paid in capital, and the remaining loss is going to be debited to retained earnings. So now we're going to go through this example here. So let's go look at what we're talking about here. So first off, we're going to be looking at the case here where we acquired 200 shares at $40 per share for $8,000, and then we're going to have we're going to reissue here 100 shares here at $46 per share here, and another 100 shares here at $24 per share. So what we're going to do is we'll go through these accounts one by one here. But first, we're going to have a cash account set up here, and then we're going to have this treasury stock account here as a contra-equity account. And we'll go through that, and we're going to also have additional paid in capital to our treasury stock, and then it's going to involve some retained earnings here on a loss when we reacquire this or reissue this treasury stock. And then we'll have a common stock here. We're just going to be using this common stock as our shareholders' equity to compare it to our treasury stock, and also to note here that we have this common stock here was sitting here, and it was reacquired. Some of it was reacquired here at treasury stock. But in using this cost method, it's not going to change the number of shares that are outstanding. We don't have to get into that right now here, but we've got this common stock here as our regular shareholders' equity. Now let's just go through this here. First, for our common stock, it was issued. We had 1,000 shares outstanding here. It was issued here at $5 par, $30 per share. So we have 1,000 shares here at $5 par for to credit that here for $5,000. And then our additional paid in capital for our common stock, that was the excess over par here, $25,000. Simply the total $30,000 that we would have received here on selling 1,000 shares less the $5,000 par amount. But all we're going to use is that we have common stock outstanding here that can be repurchased here as treasury stock, and we're going to look at the debits and credits here, and first off, trying to understand this treasury stock, that it is a contra-equity account here. So the treasury stock here is a contra-equity account. Debits here reduce a debit, which is actually a plus here on our treasury stock, reduces our shareholder equity here. And what we mean by that here, you can see your treasury stock has a debit here as an increase here, but if you compare it to the equity, a common stock equity account, a debit here would be a minus. So that's what we mean by a contra-equity here. So any increases in our treasury stock here, it actually reduce our shareholders' equity, and we can look at that further here. But then a credit here increases our shareholders' equity. So you see you got a treasury stock here of credit here. It would be a minus as a contra-equity account here, but when you compare it to the equity account here in common stock, you got a credit plus. So any reductions here in our treasury stock here increases our shareholders' equity. So that's where the reverse logic comes in, and you have to look at that in those terms here as this contra equity. And remember, a treasury stock here sits on our balance sheet as a contra equity, and then a common stock here sits as an equity here. Now, we'll go through these items here one by one. So first, for the 200 shares that were acquired here at $40 per share, and remember that equated here, we debit our treasury stock here for $8,000. That's the common stock that we reacquired here. Now, we didn't, and we're using this cost method, it doesn't affect our any entries here for a common stock or the additional paid-in capital of common stock. It just sits here at the amount we acquired. We just debit our treasury stock here for the increase that for the amount required. In this case, it was $8,000, and then in our cash account, that was what it cost us to reacquire or to acquire this stock here. $8,000 here. That was on 2-1, that relationship. So that's all we do here when we acquire a treasury stock. Debit your treasury stock, and then credit or reduce your cash account here as an asset on your balance sheet. Now, let's look at the first case here, and we'll start with our cash account where these reissuing our treasury stock here. So we got 100 shares at $46 per share here. So what that would mean is you debit your cash. We're going to receive $4,600 here for reissuing those 100 shares of treasury stock here at $46 per share. So debit your cash here, increase your cash here for $4,600. Now moving over to our treasury stock account. This is where we keep this relationship here. Well, the $40 per share, that's what it cost us to reacquire this treasury stock or to acquire it. So that's our basis here. So on 3-1 here, those $100 that were reissued, or 100 shares that were reissued here, all we take that is times $40 per share. So we'd credit or reduce our treasury stock here by $4,000. And by crediting or reducing our treasury stock here, that actually, if you compare it to our equity account, that's actually increasing. That's actually increasing here our shareholders, equity here. So credit to our treasury stock increases our shareholders' equity. And then the balancing amount here. So we got $4,600 as a debit here in our cash account, $4,000 here in our treasury stock account here. So we need a $600 credit amount here. So our credits add up to our debits here, so they balance this. So we would credit our additional paid-in capital here to our treasury stock for $600. Simply the difference between the $4,600 received here and the $4,000 that based on the cash price here that we're using here, the cost on that stock. So credit or reduce our additional paid-in capital here by $600. Now that's actually a gain here when you look at it in terms of your equity here. So a credit here is like reducing our additional paid-in capital, because it's a contra account here, is like a gain here when you compare it to your regular additional paid-in capital here for a common stock. So gain here, you credit or reduce your additional paid-in capital here, and that's because here we received $4,600 and our cost was only $4,000 here based on this cost method. So we have a difference here of $600. So credit or reduce your additional paid-in capital here for $600. So that's where our reverse logic comes in here. Okay, now let's go look here at this reissuing here, the remaining 100 shares here at $24 per share here. So we'd go down into our cash account here, debit that here for $2,400, and then the balance would go to our and then over on our equity here on our treasury for our treasury stock. That again, because we reissued at 100 shares here, again we go back to our $40 cost here per share, and that's $4,000. So we credit or reduce our treasury stock here for $4,000. And then the balancing amount here, well, this is where we're going to have a loss. We're going to have a loss because remember, we maintained our credit here, a reduction in our treasury stock based on its $40 cost here, and we only received $2,400 for those 100 shares that were reissued here. So we're going to have a loss here. We're going to have to come up with a debit balance here. We had a debit here of $2,400 in our cash, a credit here in our treasury stock of $4,000. So we're going to have a $1,600 debit amount here. And this is where it comes into play here. Our additional paid-in capital treasury stock, we would reduce it here only by the amount that's available here. We only have $600 amount sitting here, so we'd debit or increase our additional paid-in capital here by $600. Now remember, by debiting your additional paid-in capital here, you're actually reducing your shareholders' equity because of this loss. So debit your additional paid-in capital for the amount that's sitting here at $600, and then the remaining amount here has to go into retained earnings here, and on our as our equity account here, we debit or reduce our retained earnings here by $1,000. Okay, so you can see that here. You received $2,400 here for the issue, and you had a $4,000 cost in it, so the loss goes here to between here additional paid-in capital, where we debited that here by $600. It looks a bit strange because you're actually increasing your additional paid-in capital here based on that debit by $600, but in essence here you're reducing your shareholders' equity by $600, and then the balance goes into retained earnings here, the difference between the $600 here and the total $1,600 loss. So you debit your retained earnings here for $1,000. Okay, so just to review that again here, on a loss here, you debit your treasury stock additional paid-in capital, and if there's a zero balance, then the remainder here goes to retained earnings. In this case, we only received $2,400 here. Our cost was $4,000, so we had to account for that $1,600 loss. So we would have, and we've done that here based on the additional paid-in capital here that was remaining. We can't go below whatever our balance. We only had $600 here as a credit balance, so we have to debit that out here for that $600, and then the remaining here of the $1,600 went into our retained earnings here. Debit that here for $1,000. So it's easy enough to see your retained earnings here, because debit here, that loss here, the $1,000 amount actually reduces your equity here. Whereas with the additional paid-in capital, it can be a bit confusing because it's a contra-equity here. The debit, which was an increase in your additional paid-in capital, actually reduces your shareholders' equity. Okay, so now let's go up and let's do a summary review of this here. Okay, for our cost method here, you're going to summarize here. These are the rules to follow here. Point 1, in all stock transactions, no gains or losses are shown on the income statement. Now, everything, remember, nothing flowed into our income statement. Everything stayed on our balance sheet in our equity here, or we had some cash transactions here as an asset. Point 2, no gain and no loss when shares are acquired here. There's no gain or loss on shares acquired. Nothing goes to our income statement here. Only the gain or loss is recognized in those additional paid-in capitals and those retained earnings and so forth here. And then let's just go through that here. So 3, gains are credited to the treasury stock additional paid-in capital. That's where the selling price is greater than the purchase price. And then 4 here, losses are debited to treasury stock additional paid-in capital if there is any balance in it. And then the debit you retained earnings for the balancing amount here that would be required that we went over here. And this is where the selling price here is less than the purchase price. And that is why retained earnings cannot increase by any share transactions. Retained earnings can never increase, and that's the rule here. And then we have to remember here that treasury stock and the treasury stock's additional paid-in capital are contra-equity accounts, and we're going to go through those here just in a little bit of detail here. So just to point out here, treasury stock is a contra-equity. It's not an asset. It sits here in your equity section of your balance sheet here, and it's not an asset. It only affects the equity here as a contra-equity, and that's because the company cannot own itself here. So that's why you set up this treasury stock as a contra-equity account. So let's just go through it in detail here and look at it just in these terms here. So our common stock, that would be our normal equity account here on our balance sheet. So you can see a debit here on our to our common stock here would decrease our equity here, whereas a credit is a plus amount here that increases our equity here. Now, if you compare that to our treasury stock, what we're talking about is a contra-equity again here. So you see the debit here again decreases our equity, but a debit here is a plus amount here, whereas with the normal equity account here for a common debit is a minus amount. So you can see the contra effect here on these accounts. Okay, so just remember, when you're debiting here both your common stock, that decreases your equity, and debiting your treasury stock, that also decreases your equity, if you can keep that straight here. And then for the credit amount here, well, credit here actually reduces your treasury stock here, but yet increases your equity here, just as a common stock does here. Credit actually increases your common stock here, or your equity here, which again increases your equity. But just looking at debits and credits here, you can see here that they both, debits both decrease the equity here between your, comparing it to your common stock here and your treasury stock, and credits increase your equity here between your common stock and your treasury stock. And if we move over here to the retained earnings, that's also the equity account, and that would be same sign. Debits here increase or decrease your equity here, and credits increase your equity. Again, treasury stock is a contra account to retained earnings as well here. Just looking at the sign nomenclature here, so you understand that as a contra equity account. And same for the treasury stock additional paid-in capital here. Debits here, an increase in your additional paid-in capital actually decreases your equity here, and a credit here, a minus or reduction to your additional paid-in capital, increases your equity. But just remember, if you can just line these up here when you're looking at your equities between your normal common stock or your retained earnings here, compare it to your treasury stock. So whenever you're debiting something here on your equity side, you're actually decreasing your equity here, be it additional paid-in capital or treasury stock or the common stock account itself. And then looking at the credit side here, any credits increase your equity here on your balance sheet here. So even though the credit here is shown as a minus here for your treasury stock, it's actually increasing your equity, and the same here for additional paid-in capital. So just our rules here. Treasury stock, a debit, plus here, decreases your equity here. Treasury stock, a credit, minus here, increases your equity here, and that's contra equity here. And the reason we did that again here is because the company can't own itself here, so they set this up. Your treasury stock, which is actually repurchased stock that you had outstanding here, like as common stock here, it would decrease your equity here. Then again, just remember here, when you're using this cost method here, the number of shares sitting in your common stock account don't change here. It's just you take everything based on your treasury stock, based on your cost here, and the treasury stock you're repurchasing, and any additional amounts goes into additional paid-in capital. Just again here to review here again, gains here, let's just go through this one more time here. Gains, credit, additional treasury stock additional capital here increases your equity as we went through here. And again, for our losses here, debited to treasury stock additional paid-in capital decreases your equity here. And any loss in excess of the balance would be debited to retained earnings here. So when we talked about that example here, we had that greater loss. We can only debit out here is in our treasury stock additional paid-in capital for the amount that was sitting here as our credit event. We can only debit it out for that much for the loss that we looked at in this example, and then the remaining amount here under this cost method goes into our retained earnings here as a debit, or decrease our equity here in our retained earnings for the loss here. And then one other thing to point out. When our treasury stock is sold at a gain or a loss, both the asset cash and our equity increases here. And now treasury stock is purchased, the opposite would be true here. So whenever we're when treasury stock is sold at a gain or a loss, both the asset, we didn't look at it here, but the asset, our cash account, actually increases here, and the equity also increases. Regardless, if you're selling treasury stock at any gain or loss here, your cash account would be increasing, and your equity account would be increasing as well. Okay, so that takes care of this treasury stock here. Just remember, treasury stock, not to confuse everything here, but is a contra-equity account, and that's the key when you're setting up this treasury stock here using the cost method here. In the cost method, we went through that here where we had to, our treasury stock account here was maintained at its cost, and any additional amounts here flew into the treasury stock additional paid in capital. All right, so that takes care of our discussion here on a treasury stock, the cost method here for acquiring and reissuing treasury stock.